Morning there, friends. May the 4th be with you on this fine Thursday morning. Hopefully, everyone's having a great week. Obviously, Cinco de Mayo is going on tomorrow. We've got some things going on with the rates. Let's go ahead and take a look at it. It's been a little volatile, but I will say that we do have some positive things coming. So here we go, and we're off. Obviously, you see the rates are getting a little higher. I think they were closer to 6.5 last week for your averages. This is from Investopedia.com. Currently, we're closer to 7. I will say that even though this is the average, I have been quoting people lower than this. But we just want to look at the averages and not get into a super detailed situation. You can see by the chart here, we did have some movement earlier in the week by that massive red line. There were some banks were running into some more problems. Most economists that I listen to feel this is honestly the Fed Reserve is causing a lot of these problems by continuing to hike the rate. And even though all the economists that I've heard are saying don't hike the rate anymore because it looks like it's going to come down, they're going to go ahead and bring it up another 25 basis points. But when we look at things overall, there's some important information coming up. As you can see from this chart here, job cuts from the biggest companies, S&P 500 companies, the companies everyone follows to make their market guidance, have actually cut more jobs than what is considered the current labor shortage. This is huge for inflation. And a lot of people have been saying this, and we've been talking about, hey, take a look at May. There's going to be some different reports coming in May. We have this massive lag of information the Federal Reserve is looking at versus actual information. They're looking at information from like March and February. It's just now coming due. So all things considered, everyone is in consensus that going into the summer here, starting this month, we should start seeing the rates come down. We should start seeing just a better overall picture for the economy. I have no idea why the Federal Reserve is doing what they're doing. No one seems to. They just they're on their own ship and they're floating down the river, and hopefully they don't hurt us too bad, because honestly, I think they have been hurting us. They've just been way too aggressive with rates. So, I guess on a long-term stance, things will be okay. If you have buyers right now, we're floating right now, kind of waiting to see how the market responds. But the market already knows that the Fed's going to move, and it hasn't really affected things too bad. Something for realtor friends here, and I realize you won't get any money out of someone that makes a cash out refinance. But what I want to say is we're seeing this trend of where people's equity in their home is way higher than it used to be because of home prices increasing. But at the same time, because of the economy, people are spending way more money on their credit cards. So it's becoming more of a helpful thing to either cash out refinance and use that money to pay down your credit cards and get in a better credit situation. This can help you because maybe if someone's going to buy in a year, maybe they go ahead and do that. They don't have to take out full equity in their house, let the house keep going. But at the same time, instead of having maybe $3,000 that they have to pay every month to cover these credit card bills, yeah, your rate will go up, but you'll be paying way less than that extra $2,000 or $3,000 a month. Maybe your rate goes up 6.5%, but maybe your actual payment only goes up $500. So now instead of paying $2,500 or $3,000, you're only paying $500 every month. Have a higher rate, but then if you're going to move anyways, that's one option to look at. And also be aware that people can roll in debt when they're purchasing a house. So you purchase a home, you can roll in some extra debt as long as the appraisal kind of fits it in. You do like a paid off situation. It'll definitely help their debt to income ratio and help them qualify for more house, and probably help them with their monthly payments. Because again, over a 30-year note, your monthly payment is going to be way lower on that debt than it would be for some of these credit cards that are charging like 29% now, or 20% or 14%. I mean, 14 is in the past, right? Because of the economy. So here's just a look at the average loan to values of homes. Look at all the way back in 2008. So loan to value means how much equity you have in your home. What is your loan versus the value of your home? So we've gone all the way, I don't know how long 2008 was, 15 years ago, something of that nature. But people have gone from 81% average to now people are averaging 42% loan to value on their house. So they have plenty of room to use this equity to get out of whatever trap they feel like they're in, whatever monthly payments are bothering them. So I think while it's not directly correlated to maybe realtors and selling, I think it's something to be aware of, and it can actually help you probably gain some clients, and it can help just people in general, which I think we're all in favor of. That's it. Try to keep them short. If you have any questions, certainly give me a call. Obviously, I like to talk about economics. It's, a thing I do. So, uh, but also, going into this weekend, hopefully you guys have a great weekend. Hopefully you have a lot of listings. You have some buyers in the area. If you need me, I'll be around. Obviously, I work same as a realtor. So, give me a call if you have any pre-quals, if you have any questions, just want to talk about anything. Me and my team will be here. And again, happy May 4th. May the 4th be with you, and enjoy your weekend and go sell a whole bunch of houses. Bye, guys.